Harry thought he had it all figured out. After 15 years of maxing out his Roth IRA contributions, he'd built up $180,000 in his account. Tax-free growth, tax-free withdrawals, that's what everyone told him about Roth IRAs. So when he needed $25,000 for his daughter's college tuition at age 52, Harry didn't think twice about pulling the money out. That confidence lasted exactly 3 weeks. When Harry's accountant called him back after reviewing the withdrawal, her voice was different, serious. "Harry, we need to talk about this Roth IRA distribution. You might owe the IRS more than you think. $4,500 in taxes, not $1,800 in penalties, and that was just the beginning." Harry had unknowingly triggered what the IRS calls a non-qualified distribution, and he was about to learn that Roth IRAs have hidden rules that can destroy decades of careful planning. But here's what saved Harry from that $18,000 nightmare. And more importantly, here's how you can protect yourself from the same traps that catch thousands of investors every single year. The 2 5-year rules. Nobody talks about. Harry thought Roth IRAs had one rule: wait until 5912 and you're golden. That assumption almost cost him $18,000. Because behind the scenes, the IRS has 2 completely separate 5-year rules, and one of them is a financial landmine. Even advisors get them wrong. Harry was about to learn the difference the hard way. The first 5-year rule determines whether your earnings get taxed. Even if you're 65 years old, if you haven't had a Roth IRA for 5 years, the IRS will tax your earnings as ordinary income. Harry had this one covered. He'd been contributing since 2009. The second 5-year rule is the killer. This one applies to conversions. Money you rolled over from a traditional IRA into your Roth. Every time you do a conversion, you start a new 5-year clock. Take that converted money out too early, and you'll pay a 10% penalty on top of any taxes owed. Harry's problem? 3 years earlier, he'd done a $40,000 Roth conversion from his old 401k. He thought since his Roth IRA was old enough, he was safe. The IRS saw it differently. Before I show you how Harry avoided thousands in penalties, real quick, if you've ever felt like the IRS rules are designed to trip you up, drop a comment below. I'd love to hear your experience. And if this is helping you think differently about Roth IRAs, consider subscribing. I make videos that can literally save you 5 figures in retirement mistakes. Just when Harry thought he was doomed, his accountant dropped something he'd never heard of before. "It's called the ordering rule," she said, and it turned everything upside down. Because the IRS doesn't take your money out randomly. They follow a strict order, and it's the only reason Harry didn't get slammed with penalties. The IRS has a specific pecking order for Roth IRA withdrawals. First out, your contributions. These are always tax-free and penalty-free, no matter what. Harry had contributed $75,000 over the years. This money was completely safe to withdraw. Second out, converted money. But here's the twist. The IRS takes out the taxed portion of conversions before the non-taxed portion. And they use first in, first out rules. Last out, earnings. This is where you get hit with taxes and penalties if you're not careful. When Harry pulled out $25,000, the IRS considered it to come from his contributions first. Since he'd contributed $75,000 over the years, his entire $25,000 withdrawal was completely tax-free and penalty-free. His accountant had scared him unnecessarily, but the education was priceless. Harry's relief was short-lived, though. His accountant had more to tell him. "Harry, I need to ask you about something else. Did you do any backdoor Roth contributions in the last few years?" Harry's stomach dropped. Yes, he had. His income had pushed him over the Roth IRA contribution limits, so his financial advisor had recommended the backdoor strategy. Contribute to a traditional IRA, then immediately convert it to his Roth. "That's what I was afraid of," his accountant said. Here's the problem with backdoor Roth conversions that nobody explains clearly. If you have any pre-tax money in any traditional IRA, when you do the conversion, the IRS forces you to pay taxes on a portion of it. It's called the Pro-Rata rule, and it treats all your traditional IRAs as one big pot. Harry had $60,000 sitting in an old traditional IRA from a previous job. When he did his $6,000 backdoor Roth conversion, the IRS said, "You have $66,000 total in traditional IRAs. $60,000 is pre-tax, $6,000 is after-tax, so 91% of any conversion is taxable." Harry owed taxes on $5,360 of his $6,000 backdoor conversion, money he thought would be tax-free, but Harry's accountant had a solution. Roll that old traditional IRA into your current 401k at work, she said. Clean the slate. Here's the brilliant part. The Pro-Rata rule only looks at traditional IRAs, not AE 401ks. By moving his pre-tax money out of the traditional IRA system and into his workplace 401k, Harry could make future backdoor Roth conversions completely tax-free. The rollover took 2 weeks. The tax savings? Over $12,000 in avoided taxes over the next decade of backdoor contributions. But Harry's accountant wasn't done yet. There's a little-known loophole you could have used, Harry. She explained the IRS has 13 exceptions, and one of them would have made his entire withdrawal penalty-free. College tuition. He qualified and didn't even know it. So what are the other exceptions that could quietly save your retirement? Qualified higher education expenses. Harry could have pulled money out penalty-free for his daughter's tuition anyway. The IRS allows penalty-free withdrawals for college costs for you, your spouse, children, or grandchildren. Unreimbursed medical expenses over 7.5% of your income. If you have a major medical event, you can tap your Roth IRA penalty-free for the amount above 7.5% of your adjusted gross income. Health insurance premiums while unemployed. Lost your job? You can withdraw money penalty-free to pay health insurance premiums. And here's a new one that most people don't know about. Starting in 2024, you can withdraw up to $1,000 per year for emergency personal expenses without penalty. It's the IRS's version of an emergency fund exception. The documentation that protects you. Harry's final lesson was about paperwork. The IRS requires specific forms to track your Roth IRA basis and avoid penalties. Form 8606 is your lifeline. File this every time you make a non-deductible traditional IRA contribution, do a Roth conversion, or take a non-qualified Roth distribution. This form calculates exactly how much of your withdrawal is taxable. Form 53329 is how you claim exceptions to the 10% penalty. Don't let your tax software skip this. If you qualify for an exception, this form is how you tell the IRS. Keep every statement, every 1099-R, every contribution record. The IRS aggregates all your Roth IRAs when calculating taxes and penalties. You need documentation to prove your basis in each account. Harry's experience taught him something crucial. Roth IRAs aren't automatically tax-free. They're tax-free if you follow the rules perfectly. Here's what you need to remember. The 5-year rule for earnings starts with your very first Roth contribution to any Roth IRA. Once you hit 5 years on your oldest account, you're covered for all future accounts. The 5-year rule for conversions resets with every conversion. Do a Roth conversion every year? You have a new 5-year clock starting each time. The ordering rules protect your contributions first. You can always withdraw your original contributions tax-free and penalty-free, no matter your age or how long the account has been open. But most importantly, if you're doing backdoor Roth conversions and you have pre-tax money in traditional IRAs, you're probably paying unnecessary taxes. Clean up your traditional IRA accounts first. 6 months later, Harry had transformed his retirement strategy. He rolled his old traditional IRA into his 401k, eliminating the Pro-Rata rule problem. His future backdoor Roth conversions would be completely tax-free. He set up systematic Roth conversions during his peak earning years, but spaced them out to stay in lower tax brackets. Most importantly, he learned to work with the IRS rules instead of against them. Today, Harry's on track to have over $800,000 in tax-free Roth IRA money by retirement. Money he can access without worrying about required minimum distributions, without triggering Social Security taxation, and without the complex penalty rules that trip up so many retirees. The best part? Once he understood the rules, managing his Roth IRAs became simple. No more surprise tax bills, no more penalty worries, just tax-free growth and tax-free retirement income.